Welcome everyone. I'm excited to welcome you to today's presentation. We're here to explore the certification program V25 for the Professional Credit Repair Business Management Diploma. Over the next few moments, I'll be walking you through what this program offers, how it can benefit your career, and the key details you need to know. So, let's get started and discover how this certification can take your skills to the next level. Let's take a closer look at 3 key areas that support our overall operations. First, client services. This is all about how we engage with and support our clients to ensure their needs are met effectively. It's essential because strong client relationships are the backbone of our success. Next, business operations. These are the everyday activities that keep our organization running smoothly, from managing resources to streamlining processes. Efficient operations help us deliver value consistently and stay competitive. Finally, legal frameworks. These are the regulations and legal structures that guide our actions. Understanding and complying with legal frameworks is crucial to protect our organization and maintain trust with our clients and partners. All of these elements are interconnected and vital to creating a solid foundation for sustainable growth and success. They tie directly into our broader theme of building a resilient and client-focused organization. Let's talk about why credit is so essential in our economy. First, it's fundamental for housing and education, allowing individuals and families to access these crucial needs without having to pay the full cost upfront. Second, credit drives economic fluidity and growth by enabling transactions and investments that might not be possible otherwise. It helps keep the economy moving smoothly. At its core, the credit system operates on trust and accountability. When you borrow money, you're essentially promising to pay it back later, which is where trust comes into play. Both lenders and borrowers need to believe in the system's integrity. Now, what exactly is credit? It's a financial mechanism that lets people access funds today with the understanding that they will repay those funds in the future. This promise of repayment is what fuels the entire credit system. Understanding this mechanism is key to grasping how our financial system supports everyday life and economic development. It's a powerful tool that, when used responsibly, benefits everyone involved. Now let's take a closer look at the different types of credit, which are revolving, installment, and open structures. Each of these plays a unique role in how consumers and businesses access funds. Revolving credit is probably the most flexible type. It allows you to borrow up to a certain limit, and you can reuse the credit as you pay it off. Think of credit cards. You have a credit limit, and as you pay down your balance, that credit becomes available again for future use. Next, we have installment credit. This involves borrowing a fixed amount of money that is paid back over a set period through regular payments. Mortgages and car loans are typical examples. The key point here is that the payments are predictable, which helps with financial planning. Lastly, open credit structures are less common, but still important. They usually involve credit lines that are available for a certain period, and you only pay interest on the amount you actually use. Utility bills or some business credit arrangements often fall into this category. Understanding these different types helps us see how credit can be tailored to meet various needs, whether for personal expenses or business investments. Recognizing the differences ensures we choose the right credit structure for our specific financial situation. Now, let's take a closer look at the key players in the credit reporting industry: Equifax, Experian, and TransUnion. These 3 companies are often referred to as the Big 3 because they dominate the market. They collect and maintain credit information on millions of consumers and businesses. Their data is used by lenders to assess creditworthiness, which influences everything from loan approvals to interest rates. Understanding their role is essential because their reports and scores have a direct impact on financial opportunities. Throughout this presentation, we'll see how their influence shapes credit decisions and the importance of managing your credit information responsibly. Let's take a closer look at the methodologies behind the FICO and VantageScore models. When we talk about score models, we're essentially discussing the different ways these scoring systems evaluate credit risk. Both aim to predict how likely someone is to repay a loan, but they do it differently. FICO scores have been around for decades and are widely used across the industry. They focus on key factors like payment history, amounts owed, length of credit history, new credit, and types of credit used. Their algorithms are quite established and have a specific way of weighting these factors. VantageScore, on the other hand, was developed more recently and aims to improve scoring accuracy and inclusivity. It uses some different data points and scoring techniques, often incorporating more recent credit activity and sometimes including different data sources. Understanding these differences is important because they influence how lenders assess risk. It's not just about which score is higher or lower, but about how each model interprets your credit behavior. This connects to the overall theme of our presentation, how credit scoring impacts lending decisions and consumer access. So, whether it's FICO or VantageScore, knowing their methodologies helps us better understand the nuances behind the scores we see and how they influence financial opportunities. Let's take a closer look at identifying errors and red flags during report analysis. This is a critical step because catching issues early can save a lot of time and resources down the line. When we're reviewing reports, it's important to be thorough and attentive to detail. Look for inconsistencies or unusual patterns that don't quite add up. These are often our red flags. For example, sudden changes in data trends, discrepancies between different data sources, or unusual transactions can all indicate potential issues. The goal here is to develop a keen eye for what looks out of place, so we can flag these for further investigation. Remember, this process connects directly to our overall theme of ensuring accuracy and integrity in our financial reporting. By mastering report analysis and recognizing the warning signs, we strengthen the foundation of trust in our financial statements. Let's take a moment to talk about compliance, which is absolutely essential for any business operating in this space. Staying compliant isn't just about avoiding penalties, it's about building trust with your customers and maintaining a reputable operation. Now, within this framework, there are specific regulations we need to be aware of. For example, the CROA, or the Credit Repair Organizations Act, strictly governs how repair services are offered and ensures transparency so consumers aren't misled. Then there's the FDCPA, the Fair Debt Collection Practices Act, which is designed to prevent debt harassment. It sets clear boundaries on how debt collectors can communicate with consumers, protecting individuals from undue stress and unfair treatment. Next, we have the FCRA, the Fair Credit Reporting Act. This law governs the accuracy and privacy of the data in credit reports. It's crucial because consumers have the right to dispute inaccurate information and expect their data to be handled responsibly. All of these regulations tie into a broader theme of consumer protection. At the core, our goal is to ensure fair treatment, transparency, and trust. By understanding and adhering to these key laws, we not only stay compliant but also strengthen our reputation and foster healthier relationships with our customers. Now, let's take a closer look at access, dispute, and accuracy standards, which are fundamental to understanding FCRA rights. These standards ensure that consumers have access to their credit information, the ability to dispute inaccuracies, and that the data maintained is accurate and fair. When we talk about access, it means consumers have the right to see what information is being reported about them. If they find inaccuracies, they have the right to dispute that information. And that's where the dispute process comes in. It's a built-in safeguard to correct errors and ensure data accuracy. This is crucial because accurate information affects everything from loan approvals to employment opportunities. By understanding these standards, we're better equipped to protect consumers' rights and promote fairness in credit reporting. Remember, the overall goal here is transparency and accuracy, which benefits everyone involved in the credit ecosystem. Now, let's take a closer look at some of the key protections provided by the FDCPA. First, it restricts communication ***. meaning debt collectors can't contact consumers at inconvenient hours, like very early in the morning or late at night. This helps ensure that debt collection efforts are respectful of personal boundaries. Next, it mandates debt validation notices ***. This is a crucial safeguard. Debt collectors are required to send you a written notice that clearly explains the amount owed and details about the debt. This way, consumers have the information they need to verify the debt and avoid misunderstandings. The FDCPA also prohibits harassment and threats ***. Debt collectors can't use abusive language, threats of violence, or any aggressive tactics. This protection ensures that consumers are treated with dignity and respect during the collection process. Finally, the law * protects consumers from abusive third-party debt collection practices ***. It prevents collectors from engaging in behaviors that might intimidate or unfairly pressure consumers, ensuring the process remains fair and transparent. Overall, these rules are designed to create a balanced environment where debt collectors can do their job, but consumers are safeguarded from abuse and undue stress. Let's take a closer look at the Credit Repair Organizations Act, or CROA, and its key requirements. One of the most important points is that CROA strictly prohibits charging any fees until the promised services have been fully performed. This means that as a consumer, you shouldn't have to pay anything up front before the credit repair work is actually completed. The slide highlights that before services are rendered, there's a clear rule: no fees should be charged at this stage. This is a crucial protection to ensure fairness and transparency. It helps prevent unscrupulous organizations from collecting money prematurely or without delivering on their promises. These rules are designed to promote trust and accountability within the credit repair industry. So, when you're working with a credit repair organization, always remember that they are required to do the work first. Then, and only then, can they charge the fees. This aligns with the overall theme of protecting consumers and ensuring honest practices in credit repair. Let's talk about integrity, transparency, and accountability. These are the pillars of strong ethical standards. When we talk about integrity, we're referring to honesty and consistency in our actions, making sure we're doing the right thing even when no one is watching. Transparency is about openness, sharing information clearly and honestly so all stakeholders can understand what's happening. And accountability means taking responsibility for our decisions and actions, whether they lead to success or require correction. Together, these elements build trust within our organization and with the people we serve. Upholding these standards is essential because it not only aligns with our core values, but also reinforces our commitment to ethical behavior at every level. When we embed these principles into our daily practices, we create a culture of integrity that supports sustainable success and fosters confidence in everything we do. Now, let's talk about how we ensure the secure handling of sensitive consumer data. Protecting privacy is at the core of our approach, so we implement stringent measures to keep information safe. We also use standardized, legally vetted service agreements to clearly define responsibilities and expectations, which helps prevent misunderstandings and ensures compliance. To stay on top of everything, we conduct regular compliance reviews of all client files, making sure that every aspect aligns with current regulations and best practices. These steps form a comprehensive risk mitigation strategy, safeguarding both our clients and their customers. Overall, these measures are essential to maintaining trust and integrity in our services, reinforcing our commitment to responsible and secure data handling throughout the entire process. Let's talk about some common inaccuracies we often see in debt records. One of the issues is the same debt being listed multiple times, which can really skew the overall picture. Then, there are items that are simply outdated, such as debts older than the typical 7 to 10-year limit for reporting. These should be removed to keep the data accurate. We also encounter wrong names, addresses, or variations of SSNs, which can cause confusion or misidentification. These inaccuracies are quite common and can have a significant impact on a person's credit profile. Overall, Identifying and correcting these errors is crucial for maintaining a truthful and reliable credit report. Let's talk about some common signs that might indicate your identity has been compromised. First, sudden address changes can be a red flag. If you notice that your address on your credit report has been changed without your knowledge, it could mean someone else is trying to take control of your accounts. Next, unauthorized credit inquiries are another warning sign. If you see credit checks on your report that you didn't initiate, that's suspicious and worth investigating. Unfamiliar accounts or loans appearing in your report are also major indicators. These could be new accounts opened in your name by someone else. Recognizing these signs early can help you act quickly to prevent further damage. When reviewing your credit report, keep an eye out for these fraud indicators. They are crucial in identifying potential identity theft. By staying vigilant and understanding these warning signs, you can better protect yourself and respond promptly if you notice anything unusual. Let's talk about bankruptcies and liens. These are serious negative marks on your credit report that can significantly impact your creditworthiness. When a creditor writes off debt, it's called a charge-off, which means they've essentially given up on collecting that debt. This status is then often reported to third-party debt reporting agencies, making it visible to future lenders. Collection accounts happen when a debt is overdue for 30 to 180 days, and during this period, the account can significantly affect your credit score. It's important to note that late payments, especially those that are 30 days or more past due, also leave negative items on your credit history. Overall, these negative items, bankruptcies, liens, charge-offs, collections, and late payments, are key factors that lenders consider when assessing your creditworthiness. Understanding how they impact your credit can help you better manage your financial health and work towards improving your credit profile. Now, let's talk about confirming account ownership and the importance of reporting timelines. Verification is a crucial step in this process. It helps us ensure that the person requesting access or making changes truly owns the account. This not only protects the account holder, but also maintains the integrity of our system. When verifying, we need to gather the right information quickly and accurately. Clear communication here is key, making sure the account owner understands what's needed and that we handle their details securely. Additionally, reporting timelines are vital. They set expectations for how quickly we can respond and resolve issues. Timely reporting helps us act efficiently, ensuring that any concerns are addressed without unnecessary delays. Overall, confirming ownership and adhering to reporting timelines are essential parts of safeguarding accounts and maintaining trust throughout this process. Creating actionable client insights is a crucial part of our process. It's not just about gathering data, but turning that data into clear, meaningful insights that can drive decision-making. When we develop analysis reports, we focus on making them comprehensive yet accessible. These reports should highlight key trends, patterns, and opportunities that our clients can act on immediately. The goal is to bridge the gap between raw data and strategic action, ensuring our clients understand exactly what steps to take next. This approach aligns perfectly with our overall mission, providing value through insights that truly make a difference. Let's talk about another common challenge we face: inaccurate, unverifiable, or outdated data. When we're evaluating information, it's crucial to recognize that not all data is reliable. Sometimes, the data we encounter might be incorrect due to errors in collection or reporting. Other times, it might be unverifiable, meaning we can't confirm its source or accuracy. And of course, outdated data can lead us astray if it's no longer relevant or reflects past conditions that have changed. This is where dispute grounds come into play. If you're involved in a review or audit process, identifying these issues can be a strong basis for dispute. Essentially, if the data you're presented with is questionable, you have valid reasons to challenge it. It's important to thoroughly assess the credibility of your data sources and ensure the information is current and verifiable. Connecting this to our overall theme, maintaining data integrity is fundamental to sound decision-making. When we can identify and dispute unreliable data, We protect ourselves from making misguided choices based on faulty information. So, always be vigilant about the quality of your data. It's the backbone of credible and effective analysis. All right, let's talk about the different ways you can dispute information on your credit report. First, there's the online option. It's really fast and convenient, but keep in mind that it comes with limited rights. You might not have as much flexibility or detailed options compared to other methods. Next, you can dispute directly with the data furnisher. That means reaching out to the company that reported the information, like a bank or a credit card issuer, to ask for a correction. If the dispute involves a creditor, you'll be going straight to the original lender. That's often the best route if you want to clarify or challenge the data at its source. Then, there's the bureau method, where you contact the credit bureaus themselves, like Equifax, Experian, or TransUnion, directly to submit your dispute. Overall, understanding these methods is key because each has its advantages and limitations, and choosing the right one can make your dispute process more effective. It's all about connecting the right approach to the type of information you're challenging and ensuring your rights are protected throughout the process. Now, let's talk about professional structure and evidence attachment when drafting letters. First, it's crucial to maintain a clear and organized structure in your letter. This means having a proper greeting, a well-defined body, and a courteous closing. Each section should serve a specific purpose and flow logically to the next. Second, attaching relevant evidence is key to supporting your points effectively. Whether it's documents, data, or references, make sure they are clearly labeled and easy to review. This not only strengthens your case, but also demonstrates professionalism and attention to detail. By combining a solid structure with thorough evidence attachment, your letters will be more convincing and credible. Remember, this approach ties into the overall theme of professionalism and effective communication throughout this presentation. Let's take a look at the next stage, escalating unresolved or verified items. When issues remain unresolved or have been verified, it's important to escalate them appropriately. This involves follow-up actions, such as reviewing the results and updating notices to keep everyone informed. The response process typically follows a standard bureau investigation window, which is generally around 30 days. During this time, we manage the timeline carefully to ensure timely resolution. Effective timeline management is crucial here. It helps us stay on track, prioritize issues, and make sure nothing slips through the cracks. This process keeps the investigation moving forward and ensures transparency and accountability throughout. Remember, this escalation process is a key part of maintaining the integrity of our overall workflow and ensuring issues are resolved efficiently and effectively. All right, on this slide, we're focusing on the importance of adjusting plans based on the outcomes we observe. The key idea here is that strategy isn't a static thing. It's a dynamic process that requires us to be flexible and responsive. As we monitor score changes and removals, we gain valuable insights into what's working and what's not. Tracking these shifts allows us to make informed decisions, refine our approach, and ultimately improve our results. This continuous loop of monitoring and adjusting is essential for staying aligned with our goals and ensuring that our efforts are effective. Remember, the goal is to stay adaptable and vigilant, so we can pivot when necessary and keep moving forward successfully. Let's talk about the first step in our process: intake, assessment, and goal setting. This is really the foundation of effective client onboarding. When a new client comes in, we start with intake, gathering all the necessary information to understand their background, needs, and expectations. This helps us get a clear picture of where they are now. Next is assessment, taking a closer look at their current situation, challenges, and strengths. It's about understanding what's working and what might need more focus. This step allows us to tailor our approach specifically to the client's unique circumstances. Finally, we move into goal setting. Here, we work collaboratively with the client to define clear, achievable objectives. Setting goals that align with their vision and needs ensures we're all on the same page moving forward. All of these steps, intake, assessment, and goal setting are crucial because they set the tone for a successful partnership. They help us create a customized plan that truly addresses the client's priorities and keeps us aligned throughout the process. This initial phase is key to building trust and ensuring that our work together is focused and effective. When working with clients, it's essential to translate complex credit jargon into simple, understandable terms. This helps build trust and ensures they truly grasp their financial situation. Using clear language makes the information more accessible, especially for those who aren't familiar with industry-specific terminology. Remember, our goal is to bridge the gap between technical language and everyday understanding. By doing so, we empower clients to make informed decisions and feel confident about their credit options. Keeping things simple also strengthens our relationships and highlights our commitment to transparent communication. This approach ties directly into our overall theme of client-centered service and effective communication. Now, let's talk about personalized roadmaps for financial recovery. These are tailored improvement plans designed to help each organization or individual get back on track financially. The key idea here is that recovery isn't one size fits all. Instead, we need to develop specific strategies that address unique challenges and opportunities. These improvement plans focus on identifying the most critical areas for improvement, whether it's managing cash flow, reducing expenses, or increasing revenue streams. The goal is to create a clear, actionable path that guides progress step by step. What's important to remember is that personalized roadmaps are adaptable. They evolve as you make progress and as circumstances change. They serve as a blueprint, providing focus and direction during the recovery process, and ultimately helping you regain financial stability in a structured way. This concept ties directly into our overall theme of strategic, tailored approaches to overcoming financial setbacks. Let's talk about responsible credit rebuilding. It's all about taking strategic steps to improve your credit health over time. This involves implementing effective debt management strategies, which might include consolidating debts or creating a payment plan that works for you. Next, budgeting and cash flow are crucial. They help you keep track of your income and expenses, ensuring you're living within your means and setting aside funds for future needs. But beyond just managing numbers, educating clients on sustainable habits is key. Building long-term financial health requires consistent, mindful behaviors rather than quick fixes. This is where financial literacy comes into play. By understanding how money works, credit scores, interest rates, savings, you empower yourself to make better decisions. All of these elements, responsible credit rebuilding, debt management, budgeting, and education, are interconnected. They support the overall goal of achieving financial stability and confidence, which is at the heart of everything we've been discussing today. Let's talk about the importance of transparency and setting realistic expectations. When we're open and honest with clients, it builds a foundation of trust that's essential for any successful partnership. Being transparent means sharing both the potential challenges and the opportunities, so there are no surprises along the way. This honesty helps clients feel more confident in the process and in us as professionals. It also means that we're managing expectations from the start, which prevents misunderstandings or disappointment later on. The key is to be clear about what's achievable and to communicate regularly throughout the project. Ultimately, fostering transparency and realistic expectations isn't just about good communication. It's about earning and maintaining client trust. When clients trust us, they're more likely to stay engaged, supportive, and collaborative, which leads to better outcomes for everyone involved. This aligns perfectly with our overall goal of building strong, lasting relationships based on integrity and reliability. Now, let's take a closer look at the different business models that are shaping our industry today: subscription, flat fee, and performance. Each of these approaches offers unique advantages and challenges, and understanding them is key to navigating the evolving landscape. With the subscription model, customers pay a regular fee, monthly or annually, to access a service or product. This creates a steady revenue stream and fosters ongoing relationships with clients. The flat fee model, on the other hand, involves charging a fixed amount for a set of services or a specific project. It's straightforward and predictable, making it appealing for both providers and clients who prefer clarity without surprises. Then there's the performance-based model, where compensation is tied directly to the results or outcomes achieved. This aligns our interests closely with those of our clients, emphasizing value and effectiveness. Connecting these models to our overall theme, it's important to recognize that choosing the right approach depends on your target market, the nature of your offerings, and your strategic goals. Each has its place, and often, businesses combine elements of these models to create a tailored approach that best fits their needs. Let's talk about the key steps involved in establishing trust and credibility in our industry, starting with registration. This is the formal process of signing up with the relevant authorities or organizations, ensuring that you're recognized as a legitimate entity. It's an essential first step because it lays the foundation for everything else. Next is bonding. Bonding is like insurance for your clients and partners. It provides a financial guarantee that you will fulfill your commitments. This not only builds confidence, but also demonstrates your professionalism and reliability. Then we have licensing. Obtaining the proper license is crucial because it shows you're compliant with legal and industry standards. It often involves meeting specific requirements and passing inspections, which further reassures your clients that you operate responsibly. All these steps, registration, bonding, and licensing, are interconnected. They help you establish trust, open doors to new opportunities, and align your business with the overall theme of credibility and professionalism. This process is vital for sustainable growth and long-term success in our field. Now, let's take a closer look at the different pricing structures we typically encounter. First, we have one-time fees. These are single payments made for specific services or projects, which can be ideal when you need a particular deliverable without ongoing commitments. Next, we have tiered packages. These are structured options that offer different levels of service at varying price points. They give clients the flexibility to choose a package that best fits their needs and budget, while also allowing us to upsell or customize based on specific requirements. Finally, monthly retainers. These are recurring payments that provide ongoing support or services over a set period. They create a steady revenue stream for us and ensure continuous value for the client, especially when they require regular assistance or maintenance. Understanding these different models is essential because it helps us tailor our offerings to meet client expectations and align with our overall business strategy. Each approach has its advantages, and choosing the right one depends on the scope of work and the relationship we want to build. Let's talk about contracts, disclosures, and records, focusing on documentation. This is a crucial part of our overall process because having proper documentation helps ensure transparency and legal compliance. When we talk about documentation, we're referring to all the written records that support the transaction, like the contracts we sign, the disclosures we provide, and the records we keep. It's important to understand that these documents serve as a record of what was agreed upon, what information was shared, and what disclosures were made. Thorough documentation not only protects all parties involved, but also helps us resolve any future questions or disputes. Remember, accurate and complete records are essential for maintaining trust and demonstrating our professionalism. By keeping detailed documentation, we reinforce the integrity of our processes and support our overall commitment to transparency in every transaction. So always ensure your documentation is clear, accurate, and well organized. It's a key part of our responsibility. Now, let's take a closer look at CRM and dispute management technology, specifically focusing on workflow systems. These systems are essential because they help streamline and automate the processes involved in managing customer relationships and resolving disputes. By using workflow systems, organizations can ensure that each step in these processes is handled efficiently and consistently. This not only improves the overall customer experience, but also enhances accountability and transparency within the organization. When integrated properly, these systems connect various functions, enabling faster resolution times and better tracking of case progress. Ultimately, leveraging workflow systems as part of CRM and dispute management technology supports our broader goal of delivering exceptional service and maintaining strong, trust-based relationships with our clients. Let's take a closer look at some of the key elements that contribute to effective brand building. First, reviews, especially client success stories, play a crucial role. They provide social proof and demonstrate real-world results, which can significantly boost credibility and trust with potential customers. Next, social media messaging needs to be consistent across all platforms. This consistency helps reinforce your brand identity and ensures your audience receives a clear, unified message no matter where they encounter your brand. Content also matters greatly. Providing educational value through your content not only positions you as an expert, but also builds rapport and loyalty with your audience. When people see you're genuinely interested in helping them learn and grow, they're more likely to engage with your brand. Finally, your website should reflect professionalism and clarity. A well-designed, easy-to-navigate website acts as the digital storefront for your brand, making a strong first impression and guiding visitors seamlessly toward desired actions. All of these elements, reviews, social messaging, content, and website design, are interconnected pieces of the larger puzzle of brand building. When executed thoughtfully, they create a cohesive, trustworthy, and engaging brand presence that supports your overall goals. Today, I want to talk about nurturing leads with valuable financial tips. This is all about building trust and positioning ourselves as a helpful resource. One effective way to do this is through targeted email campaigns. These emails should be insightful, relevant, and compliant with Google and social media advertising policies to ensure we're reaching the right audience without any issues. Next, we have advertising, specifically creating ads that are optimized for local credit repair searches. When people are actively looking for credit solutions nearby, our ads need to appear prominently. That's how we connect with potential clients at the exact moment they need our services. And of course, SEO plays a crucial role here. By optimizing our digital presence for local searches, we make sure our website and content are easily discoverable. This integrated approach, combining email marketing, compliant advertising, and SEO, is essential in digital marketing. It all ties back to our goal of attracting and nurturing leads effectively, ultimately helping us grow our credit repair business. Let's talk about referrals, partnerships, and conversion, which are all crucial components of lead generation. These elements help us expand our reach and build trust with potential clients. Referrals are powerful because they come from satisfied customers who recommend us to others. This often leads to high-quality leads. Partnerships, on the other hand, allow us to collaborate with other organizations or influencers that share our target audience, opening up new channels for lead generation. And then there's conversion, turning those leads into actual clients. The key here is to nurture those relationships, provide value, and make the process as seamless as possible. When we effectively leverage referrals and partnerships, we not only increase the number of leads but also improve the quality of those leads, which ultimately boosts our conversion rates. All of these points tie back to the overall theme of building a sustainable and scalable lead generation system, one that relies on trusted relationships and strategic alliances. So, by focusing on these areas, we're setting ourselves up for long-term success in attracting and converting new clients. Now, let's talk about the importance of transparent agreements without pressure. It's essential that we create a space where clients feel confident and comfortable, knowing that there's no pressure to make immediate decisions. This builds trust and lays the foundation for genuine relationships. When we move to closing, our approach should be to present tailored improvement plans. These plans are customized to meet each client's unique needs, showing that we've truly listened and understand their specific pain points. Solutions come next, and they should always start with understanding the client's pain points first. By deeply understanding their challenges, we're better equipped to offer meaningful, effective solutions that resonate with them. Listening is a key element throughout this process. Active listening allows us to gather critical insights and demonstrates our genuine interest in their concerns. Finally, ethical sales are fundamental. Maintaining integrity and honesty ensures that our clients see us as trustworthy partners, not just sellers. All these points tie back to our overall theme: building authentic, pressure-free relationships by understanding, listening, and acting ethically. Let's talk about the importance of rewarding client advocacy and referrals. When clients feel valued and appreciated, they're more likely to recommend us to others, which can significantly grow our business. One effective way to encourage this is through incentives, offering rewards or recognition to clients who refer new business or advocate for us. But it's not just about giving rewards. We also need to measure satisfaction and gather feedback. Conducting surveys is a great way to understand how clients perceive our services and identify areas for improvement. Regular progress reports are also essential. They keep clients informed and engaged, reinforcing transparency and trust. When clients see consistent updates and feel their opinions matter, they're more likely to stay loyal and refer us to others. So, focusing on retention and referrals isn't just about one-time wins. It's about building long-term relationships that benefit everyone involved. This approach ties back to our overall goal of creating a strong, client-centered strategy that fosters growth through satisfaction and advocacy. Building a strong team of specialists is essential as we see increased volume in our operations. It's not just about hiring more people, but ensuring that each new team member is equipped to handle their specific responsibilities effectively. This way, we can maintain our high standards for compliance and quality, which are critical to our success. Management and training play a pivotal role here. We need to develop robust training programs that bring everyone up to speed quickly and keep them aligned with our standards. Good management ensures that our team remains motivated, focused, and capable of handling the growth seamlessly. Scaling our team is more than just adding heads. It's about strategic expansion. We want to grow responsibly, making sure each new team member is a good fit and that we're reinforcing our culture of excellence. Overall, this slide highlights how vital it is to build and develop our team thoughtfully, so we can handle increased volume without compromising on quality or compliance. It's about creating a solid foundation for sustained growth. Let's take a look at some of the key ways we're enhancing operational efficiency through technology. First, systematic follow-up alerts are crucial. They help ensure nothing falls through the cracks by automatically notifying our team when action is needed, keeping our processes smooth and timely. Next, client portal integrations play a vital role. By connecting our systems directly with client portals, we make communication more seamless and transparent, which improves client satisfaction and reduces manual work. Automated dispute tracking is another important aspect. It allows us to monitor and manage disputes efficiently, reducing the time and effort required to resolve issues and preventing delays. All of these elements, alerts, integrations, dispute tracking, are about leveraging technology to work smarter, not harder. They help us streamline operations, minimize errors, and ultimately deliver better service. This focus on automation ties directly into our overall theme of improving operational efficiency through innovative solutions, ensuring we stay ahead in a competitive landscape. Now, let's turn our attention to standardization and quality control, especially when dealing with disputes at scale. As the volume of transactions or interactions increases, maintaining consistent standards becomes more challenging, but also more critical. Disputes can arise for various reasons: misunderstandings, miscommunications, or simply inconsistent processes. What's important here is that having clear, standardized procedures helps us manage these disputes more effectively. It allows us to identify issues quickly and address them uniformly, which in turn builds trust and reliability in our system. Quality control measures are essential to ensure that these standards are upheld across the board. They help us catch errors early, prevent escalation, and maintain a high level of service or product quality, even when dealing with a large scale. In the broader context of our presentation, this highlights that as systems grow, the importance of robust standardization and quality control only increases. It's about creating a resilient framework that can handle disputes gracefully and keep everything running smoothly. Let's talk about some key aspects of maintaining a strong safety framework. First, data security protocols are essential. They help protect sensitive information and ensure that our data remains confidential and secure. Next, when we identify process gaps, we focus on fixing them promptly. This is all about continuous improvement and keeping our operations smooth. Training is also a vital part of the picture. Regular updates for staff on legal requirements keep everyone informed and compliant with current regulations. Then, we have reviews, which involve regular file inspections. These checks help us verify that everything is in order and that our documentation remains accurate. Finally, compliance audits are crucial. They provide an overall assessment of how well we're adhering to policies and standards. All of these elements work together to strengthen our safety and compliance culture, which is at the heart of our overall strategy. Now, let's talk about the importance of tracking success rates, retention, and revenue. These metrics are key indicators of our long-term business health. By regularly monitoring them, we can identify what's working well and where we might need to make adjustments. Next, measuring performance through KPIs, key performance indicators, helps us stay focused on our goals and ensures we're moving in the right direction. These KPIs should be aligned with our overall strategy and provide clear insights into our progress. Sustainability is also a crucial aspect. It's not just about short-term gains. We need to ensure our growth is sustainable over time. This means making data-driven decisions that support long-term success and stability. Connecting all these points, it's clear that continuous measurement and evaluation are vital. They enable us to adapt, improve, and ultimately achieve our overarching vision for the business. Now, let's turn our attention to strategic growth and service innovation, which are crucial for our long-term success. One of the key components here is market expansion. This isn't just about increasing our customer base. It's about exploring new markets and opportunities that align with our goals. By doing this, we can tap into new revenue streams and strengthen our competitive position. Market expansion requires careful analysis and a clear understanding of regional needs, customer preferences, and local regulations. It's about adapting our offerings to meet those specific needs while maintaining the quality and value we're known for. Ultimately, this approach connects directly to our broader vision of sustainable growth. It's not just about growth for growth's sake, but about strategic, thoughtful expansion that drives service innovation and enhances our overall market presence. Launching your career in credit repair management is an exciting step forward. Today, I want to emphasize the importance of maintaining professional excellence throughout your journey. This means not only mastering the technical aspects of credit repair, but also delivering exceptional service to your clients. Building trust and credibility is key, so always prioritize integrity, transparency, and effective communication. Remember, your reputation is your most valuable asset in this industry. By consistently demonstrating professionalism and a genuine commitment to helping your clients improve their financial lives, you'll set yourself apart and establish a strong foundation for long-term success. Keep these principles at the core of your practice, and you'll be well on your way to a rewarding career in credit repair management.